Today's eye-opening financial video is about how creditors, bank, loan providers, how they reel you in to paying a little bit more so that you can be properly protected. Hi, I'm Irene, and I'm your BFF when it comes to helping you navigate through your financial questions, challenges, and let's just say worries. Today, we're actually going to be talking about what you might be paying in addition to your existing loans, your mortgages, credit card debt. And that is the subject of insurance, or otherwise known as creditor protect. Now, don't get me wrong, there's nothing wrong with having proper insurance. I should know. I am a licensed insurance agent, and I'm legally licensed and bound to different compliance and rules for a few different provinces here in Canada on how to properly present solutions around insurance. The thing is that when you're dealing with a lending institution, whether it's a bank or just another lending institution where you're borrowing money, is very unlikely they are licensed insurance agents. So they're not regulated by the same rules as we are as licensed insurance agents. In fact, you might be surprised to know that the insurance industry is even more regulated than the banking industry, at least here in Canada. So there are certain things we have to abide by. Nonetheless, I do want to make known of 4 different ways that banks or lending institutions sell you creditor insurance. Sometimes they call it creditor protection, or just mortgage life insurance, or loan life insurance. One of the ways that they present to the consumer when they're getting the loan set up is they add it to the monthly payment. So have you ever walked into getting a car and they ask you right away, what is your payment that you're comfortable with? And you tell them, oh, I'm okay with maybe $400 a month on a car loan. And then they ask you what car you want. And of course, they do that whole spiel and get you into a car that you might like. And then they go back and work the numbers. And they come back to you with a number that they feel you said you were comfortable with. I was taught to do this when I worked at the bank for quite some time in terms of loans, where I would present the loan payment with the creditor protection inside of it. And usually when the customer would say they were fine with that payment, I would go into, oh, and by the way, you're protected if something were to happen to you, like you're to pass away or you're to become disabled, these payments would be taken care of. And that leads me to number 2, another way that creditors will try to sell you on the insurance is they explain that if something were to happen to you, nobody would get left with this debt. You'd be rest assured that it would be taken care of. So that's tactic number 2, where they use fear as a way to explain to you that you're not going to leave it as a burden to somebody else to take care of. So to come back to how they would add it to the monthly payment, most of the time, because people have already said they're comfortable with that payment, and then if they were to get a loan from the bank and they're like, yeah, I guess I'm fine with it. I already said I was fine with it. Or yeah, I wouldn't want to leave that to anybody, right? This typically existed with loans or car loans. Mortgages are a different story because, of course, mortgages are larger payments for most people. And how somebody might position insurance is they still might add it to the payment, but then really explain to the client that this is going to be the largest debt that you're ever going to have. So you wouldn't want to leave your spouse to be homeless if they had to bury you at the same time, or you wouldn't want to take your kids and pick them up and bring them to a home that doesn't belong to them after they've just buried their father or buried their mother. I know it sounds really cool to say something like that, but again, these are tactics that people use to try to get you to use and take their mortgage insurance. Now, it's true right? Nobody really wants to leave the burden to anybody they love. But what people don't realize is that creditor protection is not guaranteed to pay out when a claim is made. Okay? Here's one of the biggest reasons why. So if any of you guys have ever taken on mortgage insurance, do you remember ever going through blood work or a urine sample or a long-winded questionnaire? Do you ever remember that? Or do you remember the banker asking you 3 really loaded questions where you just say yes or no? Typically, if you remember the latter, the second one, where you just remember your banker asking you 3 really large questions and you answering yes or no, typically it's those insurances that the underwriting, if you were to ever claim, is done at the time of claim. So for those of you who don't understand what that means, basically it's this. If something were to happen to you and you were to go to your bank and say, I need to claim disability, so I know I paid for disability on my mortgage, I can't work. So what happens is that at that time, the insurance company will decide if they're going to pay out the claim or insure you, because that is the nature of that protection. It is, you're paying for it. There's no real underwriting, meaning they're not determining at the time you say, yes, I want it, that you qualify. Okay. They're not determining it at that point. So therefore, when a claim is made, they can still say no, which means that if you've been paying into your mortgage for years, or mortgage insurance for years, whether it's disability, accident, illness, whatever it is, life, and something were to happen and somebody were to claim, whether it's you or a loved one, if you were to pass away, it's very possible the insurance can go back and say, no, sorry, can't do it. You just, in your health history, it shows that you went to the doctors and you got your blood pressure measured and you didn't tell us that you had a blood pressure problem. So we're going to say no. And you're wondering, what? I thought I got it. I paid for it. You've been accepting my payments. What? And I need to explain this to you. When you take on your own separate, let's say, life insurance policy, your own disability insurance policy, your own critical illness insurance policy, you have to go through many hoops. Yes, maybe it's just a long application form with your insurance agent, but at least you rest assured that you've gone through everything they needed you to, that the contract, unless you lied, of course, but the contract is pretty much ironclad. So if something were to happen to you, there's no question that your claim would be paid out. I do have to put in a caveat, of course, if you didn't lie on your application. Okay. So that is the other thing, is that they add the monthly payment that you said you were comfortable paying. And that's how people get roped into getting insurance on their lending product. One of the other ways a banker might try to sell you on creditor protection on their loan or mortgage or line of credit is they say, oh, take it. You can cancel it, get your money back in 10 days if you don't like it. Take a look at it, read this policy. It's usually a very general policy, and then come back and cancel it. If it's 10 days, most people are not willing to go through policy, let alone read the documents for their loan, but they're not willing to go through it, and they'll never remember to come back. And unfortunately, the banks are kind of banking on this. The banks are relying on this tactic that you won't come back. Very related to this, and this is now the fourth way that someone will try to sell you creditor insurance or mortgage insurance, is they'll say, take it. I don't feel comfortable with you walking out of here without taking a look at your current coverage, whether it's stuff you have at work, stuff you have separately. Take it, look at your current coverage. And if you know that you have enough to cover this big debt, in the case of a mortgage, then come back and cancel. And again, they're relying on the fact that most people won't. They're not going to go back to their insurance coverage that they have at work, or they're not going to go back to the thing they thought they had when they signed it up 10 years ago because they don't even know where it is, right? So they're just going to keep it. So that sounds like you. And if you're paying something separate, on your mortgage, your line of credit, your loan, I would encourage you to reach out to me. Okay. All I ask is that you dig out whatever you think you have. And I would be happy to look at it for you to see if you do, A, have enough, and maybe you can cancel that thing that you took out at the bank, or maybe you don't have enough, and that can explain what you actually have. Because, of course, circumstances change over time. You might have had enough when you were, 20 years old, but now you're 40 and you have a mortgage, 3 kids later, a car loan, many financial goals. It may not be enough. Okay? So, for you advisors, bankers, life insurance agents, please re-watch this video. Okay? Rewatch this video and erase those tactics. Now, I can't really say this to the bankers because I'm sure you have targets. You have targets that you have to reach in terms of how much insurance penetration you need to reach so that you can get paid your bonus or get recognized, or those are just your targets. That's your job. I get it. Okay? I 100% get it. There is a way to make sure that somebody is properly protected, still reach your target, but also make the proper recommendation to talk to a licensed insurance agent so that they are actually properly protected. And if, God forbid, something happened to your clients and your client had a good insurance agent to take care of what they need, the bank will be paid because they would have had proper insurance. And naturally, when the claim happens, it's probably going to be guaranteed it'll be paid out. Okay? And then for you insurance agents, be aware that this happens. Okay? And this is another arsenal. No, this is another tool that you can stick in your arsenal of tools to explain to the client, hey, do you remember when you got the mortgage, if part of your mortgage payment covered something called life insurance or critical illness insurance or disability insurance, even job loss insurance? Find that out. And if you asked it in that way, you at least can speak the same language that the banks are speaking. They will remember. Yeah, that sounds familiar. Oh, okay. Do you happen to have your mortgage documents, by the way? Do you remember where you kept them? And then be the one that volunteers to look at it for them, because they're not going to remember most of the time. Most people don't, and that's okay. It's boring to read, but be the volunteer to work on their behalf. Be their advocate. Okay? So I hope you got value from this video. Again, this is a video meant to train you, people who are in the financial industry. I know who you are. I know what you do. This is a video that no one can unsee now. Buyers beware, consumers are smarter. And I hope for those of you guys who are just consumers, not in the financial industry, reach out, comment, share this video with people. And I got you all. Have a good day.